Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Okay. Hey everybody, this is Tuesday Tech Talk. I'm David Blake, and we're going to just review the last couple of days in the market, try to figure out what's going on, and then we're going to talk about a little bit about resistance and areas that the market's starting to run into. Hopefully we'll keep it to about 20-25 minutes. I'm not very good at that, but I think today it's going to be a little bit shorter, so we should be good. Then we're going to look at a couple of the industries and see what's leading the market. All right, last week was kind of an interesting week. After this big run-up over the last 3 or 4 weeks, we consolidated some of the gains, Monday, Tuesday, Wednesday, and Thursday. And then Friday, stocks took off again, and some of them actually broke through their 200-day moving average. They kind of did a little stutter step after the ECB cut rates further in negative territory and increased the bond purchasing program. But when Draghi suggested that the ECB wouldn't be lowering rates again, the euro spiked a little bit, the U.S. dollar weakened. And that was kind of the opposite of what he wanted out of his rate cut deal. So then he kind of backpedaled, and global markets all took off across the board on Friday. Okay, that took the different indexes basically up to our secondary targets, and I think it's kind of where the major resistance is now. We're back up right around the 200-day moving average. Some of them are struggling to get to that. We have some of them have broken through some of the Fibonacci retracements, and we'll take a look at that on some of the charts moving forward. All right, first, the good news. Several indexes have retraced about 61.8% of their move down from last fall's highs. That's a Fibonacci retracement level, and there's good support that good evidence that when a stock or index can retrace that amount of a move down, the 61.8%, a lot of times it can actually retrace the full amount. There's actually a report last week on CNBC. It reported that 88% of the time that the Dow Jones has retraced 61.8% of a move lower, it was higher 3 months down the road, and on average that return was about 9.6%. So that's a positive going forward. The bad part is that we're seeing some not necessarily negative divergence. We're seeing something in the 14-day RSI called a negative reversal on some of the indicators, and we'll go over that real shortly. Okay. This chart is something, as you can see, negative divergence is when the market will start to make newer highs, but the RSI, the 14-day RSI, will start to make new lows. What a negative reversal is where it's on a downtrend where you have a rally. The RSI may go up to, say, 50 or 60, like right here on this, where the W is here. And then we make a new low where we come down to a Y. Okay, now we rally off of that low, and the 14-day RSI actually goes above where it was at a higher price. What this means is that the stock or index is actually more overbought at a lower price than it was over here, and that they call that a negative reversal, because once it rolls over at that point, you usually will go down and take out the old low. And next week we're going to go into this a little bit more and actually show you where targets could be if this thing starts to head south again. All right, here's the Dow Jones. As you can see, last week we finally got above the 200-day moving average, I think on Friday of last week. We also cleared the 61.8 reversal of this move down from about November. You have a trend line, descending trend line coming up here around 17.4. Like the charts say, once we can get through this 61.8, there's a good chance that you'll get up close and almost retrace this full amount. Now, we are very overbought, and you actually, on the RSI on this one, you don't have the negative reversal. You actually have, it's still moving pretty well. I think that you may actually probably get a rally in here, probably around the 17.6, but it's going to be some hard going here because through this next resistance level. The S&P 500, it also made it up above the 200-day moving average on Friday. Yesterday added a little bit more, but today we actually, I think we may have fallen. Yeah, we fell back below it over here, so it's struggling at that point. It's also struggling at the 61.8. Again, we're overbought on the 30-day stochastic, but MACD says we should go a little bit higher, and I think you could probably, with this one, you'll also see a little bit sideways to higher move over the next couple of weeks. NASDAQ, still not as good as what the two big ones are. We have retraced about 50% of this move down, but we're still below the 200-day moving average, and we haven't quite made it up here to the 61.8% reversal or retracement. So it has some more work to do. I think we can see with technology right now is one of the best performing sectors over the last week or two. I think we can see the NASDAQ probably get a chance to move up here to around the 48, maybe 4,900 area over the next couple of weeks. Again, not quite. It's had a heck of a move off of here, off the bottom, but the Russell 2000 is struggling over here at the 50% retracement from the move down here in December, actually, for that. And then the 200-day and the descending trend line come to play around 1140. Today we're at 1068, so we've got up another 80 points to go before this thing hits its main resistance. But this is the first index that I want to show you over here with the negative reversal in the 14-day RSI. So back here in the end of December, we're up here around 1200 on the Russell 2000, and if you come down here, you're looking at the 14-day RSI. Actually, only made it up to probably around 50, something like that. Okay, so now we've pulled back and we've come up, rallied off of that. We got to around 1090 the other day. We're at 1088 right now, or 1068. Yeah, we're down about 1.5% today. So we're back down in here, coming back down towards the 50-day. But here you can see, on this rally, the RSI made it up to about 90 something. So what we're going to end up showing you next week is how to, if this thing rolls over and comes back down to break the 50, what the downside target will be using this negative reversal with the 14-day RSI. But this is starting to get, it's way overbought. It's underperforming today. Like I say, we're off about 1.5%. You want to watch that. Next is on the Dow Jones Transportation Index, which we've talked about for quite a while. We're in a nice upward channel. You haven't quite made it up to the 200-day moving average, up around 78.50. Then you have a descending trend line coming back here right around the 8,000 level. I think we'll probably get up here on the 200-day moving average at around 7,800, 7,850, and that's going to be that may be about it for a little while. You also have a negative reversal on the transportation index, which is bothersome. Again, we are back here. We're around 50 on the RSI. Okay, now we're down here about 400 points lower. Yet the RSI has made it back up into about 90. So that's a little bit troubling. That can signal a negative reversal. Okay, as far as the internal in here, this is the new NYSE advanced decline line. We look at this almost every week, and we are actually making highs for the year on the NYSE. Good participation, broad-based. That's what you want to see. But now we're starting to see negative divergence on the NASDAQ advanced decline, which means maybe it's starting to thin out as far as leadership goes. This is where we were back around 327. We're down here around 333 negative since the first of the year. Can't quite make it up and have the participation that we've seen on the NYSE. So basically, the conclusion is here. I think that now that the Dow Jones and the S&P 500 have cleared the biggest hurdle for the market, I think we could probably work our way sideways to up over the next week or two. The longer the 200-day holds for the Dow and the S&P 500, the more likely it is that we get a start for a new leg up. You want to see if the Dow is going to be the leader. We don't want to see it marching higher while the other ones stumble. They call that when the generals march alone. We're getting close to that at this point right now. So we'd like to see the other indexes kind of catch up a little bit. A lot of times what happens also when it clears the 200, some of the shorts will throw in the towel. So keep an eye on the NASDAQ and the Russell. We want to see if they can, if the Dow will pull them up to their 200-day moving average, or whether the weight of them not being able to get that high is going to make the struggle for the Dow. But also, again, we want to keep that negative reversal in line. If this thing starts to roll over and selling intensifies, next week we can actually look at where a downside target could be. All right, so what's leading the market right now on this this last leg up? Of course, materials and energy have done well, but as you can see right here, okay, on the descending trend line, the materials are starting to got to this 200-day moving average that's overbought, and today it's one of the worst acting sectors. In fact, the mining stocks and the gold stocks and stuff are one of the worst performing. It's down 1.1%. Energy's down almost 2% today. So we made it to the major resistance line here on the materials, and at least for today, we're rolling over. We want to see if we can come back here pretty quickly and take another run at that. If we do, I think you're probably going to run out of gas on the materials up here right around 46. Right now we're about 43.63. So upside, I think, is going to be limited for the materials. We're coming back down, and this is called a throw over when you go outside of a moving channel or a channel like this. So if we come back into this channel, then you're still in that descending channel, which you want to watch. And again, we're also seeing the negative reversal on the 14-day RSI for the materials sector. Okay, the next one we have the energy sector. You can see we're still in that downward channel despite the move higher. The energy tried to get over here. We're down 2% today to 60 and change, so we're over here. Can't quite make it up to the 200-day. Can't quite make it up to the descending trend line or the 61.8 retracement level. Overbought. Again, we also see the negative reversal on the RSI 14-day there too. But I think you'll probably get sideways to maybe up a little bit higher. This thing probably stalls out somewhere around here, around 67, I think. That's my best guess on that. Unless for this thing to get back up here and break this solidly, I think you're going to have to see oil prices get up around 45 or 50. I don't see that happening right at this point. Okay, now this looks good. This is the tech sector, which hopefully can lead the NASDAQ a little bit higher. You had this reversal, a double bottom over here. We've had a nice bounce, took out the 200-day moving average, clicked off this descending trend line, and today we're actually a little bit higher too. It's flat today, but this looks pretty good. The negative reversal of the 14-day isn't as prominent as in some of the other sectors, but I think this probably takes a run up here to this 44, 45 area, almost up to new highs, and we'll see what happens over there if this ends up being like a double top on that area. Next one we see is industrials. Again, you're up here, this trend line, descending trend line, which is where it's stalling. You're off a little bit today. If we can get pushed through that, we might be able to see this thing work its way up, 57, 58. That area, it looks pretty good to me. I think you can, as long as the dollar stays a little bit weaker, I think you can, the industrials are going to outperform a little bit better. Next, we have the consumer staples. The reason I brought this up, as you can see, this thing's making new highs, but what I don't like is I think this would be one where I would start to take some profits on the consumer staples. One of the problems is with this, you're trading on this at around 21 times earnings for staples, and they pay a great dividend, and they it's a defensive sector, but you're getting very overstretched on this. People have moved into these the Procter & Gamble's and the Colgates and that kind of stock, mainly as a defensive stock. And I think that at this stage, you probably want to consider lightening up. If you're long, maybe hold on to them. But I wouldn't be putting in new positions in consumer staples at this stage. I just think it's gone too far, too fast. As you can see, you're starting to get a little bit of negative divergence on the RSI, where it's not able to make it to new highs as the sector's making it to pushing to new highs. So that's when I would start to think about, not necessarily lightening up. I would hold. I wouldn't put new money into that. Okay, now what's not working out too well right now? Basically, the healthcare spider. You can see the descending trend line. We're struggling at this 50% retracement level. We're off almost 1.5% again today, down here to 67. So we've fallen back below the 50% retracement level. You need some participation in that. You also have the negative reversal on the 14-day RSI down here too. So I'm not looking to put fresh money into the healthcare sector. I think this is probably going to be one that's going to roll over and lead us down again. And finally, before we open this up for some questions, the financial sector also, you're stuck in this downward channel. You had a lower low over here. You're still making lower lows and lower highs. Again, you have the negative reversal on the 14-day RSI overstretched, and I don't think you're going to see the financials today. They're off almost 1% down here around 22. So you're battling this 50% retracement level from the lows there, and I'm not sure we're going to how much unless the broader market can have a little kick here in the next couple of weeks. I'm not sure you're going to even get up to the 200-day moving average on that. So, in conclusion, just to wrap it up. But I think over the next 2 weeks, we're at that point where if this is just going to be a counter trend rally, it's probably going to run out of gas right in here. They usually don't go up, have a V correction again. But I think struggle to see what's going to happen over the next week or two. You have a lot of input from the central banks over the last week. We have the FOMC meeting wrapping up again on Wednesday. Hopefully Yellen won't be too hawkish and scare the market away there. But another fact that shows me that we're getting pretty close to getting to the top. We have 88% of stocks are above their 50-day moving average, which is fairly rare to get that overbought. Part of that is because the 50-day moving average for most of these indexes is still heading down, which may cause part of that. But in general, I think that in a bull market, it's all about making higher highs and higher lows, and we have not made a higher high yet, and we have not made a higher low yet on any of the indexes. So at this point, until we can take out those highs from December, this may be about the conclusion of the counter trend rally and what could be another move down here soon. Now, what changes all this? You start to see some sideways action in the indexes, and finally, if you get a chance where at least more than just the Dow and S&P, if you can get the transports and the Russell 2000 breaking out above their 200-day moving average, and you see the RSI relative strength and move sideways a little bit, it could work off that overbought area and then start to move higher. But as of right now, I think we've you've just about you're running out of gas on this rally, and I would be very cautious, especially about putting new money in. I would probably stay on the sidelines, maybe hold your positions, for the next week or two to see if what happens. If we start to fall back below some of these 50% retracement levels, then I would again lighten up and see where it goes. The next week, especially if we start to have a pullback this week, we might look at how you can determine targets using the negative reversal and the RSI. And that's about it for me right now. I see we've got a couple questions coming in, so let me close this down and we'll get to the chart. Oops. Oh, no. I hit an upgrade process. Let's get to the questions while it's updating. Cancel. There we go. Got it. Okay. For the questions, here we are. Okay, oops. Okay, if you were looking for the best leading indicator, do you go with the positive tech or the more negative Russell? Well, you kind of have a little bit of a split market right now. You have the big caps are outperforming, and as you can see on that NYSE advanced decline line, it's a fairly broad participation. But you'd rather see the Russell 2000 as one of the leaders also. But like I say, I just believe that we're going to kind of run out of gas. I don't think you're going to see a lot more upside. I think you're going to go sideways in a trading range until we start to get more involved with the first quarter earnings, which were, last I heard, they were supposed to be down about 4 or 5%. So, I'm looking to lighten up. Maybe not just go out here and sell everything, but I'm probably not adding the positions at this stage. I'll let it ride and let the markets go. If it starts to roll over, then you come out of it. What influenced the release of the e-book at this time? Is the information in it is relevant for ETF investors versus individual stockholders? Yeah, I think it is. One of the things we brought back recently is the CTI. Tom Ventresca, who wrote the book Trade Like a Pro, he's been involved in the business since I think the late 70s. And it's good to get guys like that and have them give their opinion on what's going on. They've seen more than one bear market. They've seen a lot of rallies. A lot of guys that are out there right now have never seen a bear market. They've seen a couple V corrections over the last couple of years, and they may have been around for the financial crack back in 2008, 2009. A lot of them haven't. So when you have somebody that can you can learn something from for a free book, I certainly would take a look at it. And all that he's written about in there applies both to ETFs and to individual stocks, as well as the broader market too. Okay, EWZ Brazil. Are we in a rally? We're in a rally as far as what's happening in emerging markets, but again, I believe that we may be actually coming out. Here's EWZ. We've had retracement. Let's just go back to this for retracement. You're bouncing off these lows over here. For this thing to be a true rally, you want to see it get up here. You broke over through the 200-day moving average. You pulled back today to this 24 and change. You're battling this right now. You want to make sure this thing doesn't roll over and trade below 24. That would be a negative for Brazil. I do like some of these, like the Peru, Colombia, Brazil. Latin America looks pretty good. And some of our emerging markets portfolios that we look at, countries that get a lot of their growth from the materials, like Canada, Australia, even Russia, have done pretty well over the last couple of weeks. If that's going to continue, you want to see these things hold their 200-day moving average. And if the commodity rally stays, and for that to stay, we're going to see the dollar keep weakening. These stocks should do well. I think it's probably a little bit oversold over here, and we're getting back more to normal. But I like Brazil. It's down today, but again, as long as the commodity rally can go a little bit further, I think you're okay. Anything else? Like today, if you're long these commodities and mining stocks, you're getting hit pretty hard today, despite the fact that the Dow's only down like 30 points. But again, the Russell 2000 is down 1.5, and a lot of the damage has been done in the commodities and the oil-related stocks. And energy sector's down 2%, and I don't know whether that's just some profit taking because the dollar, the dollar's up a little bit. It's basically flat today. But I think you're just having some people getting nervous about these resistance zones, and until the broader market can bust through these levels, you probably are going to have some people taking money off the table because the Dow's up about 12% from the bottom, the Russell's up more than that, but again, until we start to make new highs, we're still in a counter trend rally. THD. Okay, let's take a look at that. This is Thailand. Thailand's done well over the last, again, you see quite a bounce off here from about 55 to about 66, a real nice rally. You're seeing the RSI is making new highs. I think you beat out the 200-day moving average on this. Again, it's a stock that I'm not sure why, what the commodity factor is on this, but Thailand, relative strength-wise, looks good. I've liked this over here. I think it's you've taken out the resistance on this, and I think it can work its way a little bit higher. If you're going to emerging markets, if you go into our ETF center, you can screen for the, sometimes it's better to buy individual countries, buy like 5 or 6 of the top performers rather than just buy a fund that's going to take in the ones that are, struggling and having problems along with the little individual country ones. But yeah, the Thailand ETF looks fine. Linda Risby has a question. I don't see anything. What about RIO? Okay. I think that's also one of the Brazil ETFs, isn't it? Oh, Rio Tinto, I'm sorry. Okay, you have the negative trend line coming in right over here, which is going to coincide with the 200-day moving average. You've had a pullback here where you're not overbought anymore. Let's see. I would say, as long as the market stays fairly well, this is probably due for a little bit of a bounce. See if we can get back up to this 33 area. At that stage, we'll see what happens if we can get through the resistance on that. But you have some pretty significant resistance on this descending trend line right here. Okay, I actually kept it to 30 minutes today. Again, next week, what we want to see going forward here is how the market reacts to the FOMC, and if by chance we roll over here over the next week or two, then we'll go into this negative reversal using the 14-day RSI, and it'll help you see how you can set up targets on stocks and indexes using that indicator that way. But for right now, again, I think we can probably go sideways and stay in the trading range for a little bit, see what happens with all the central bank interventions, and then we'll start to concentrate again back on earnings and see where that's going to take us. Well, thanks for joining. I tried to keep it a little bit shorter for a change, and we'll see you next week. Again, if you have any questions during the week, feel free to send them to the doc at marketedge.com, and we'll get around to them. Thanks a lot.